Welcome to the Real Estate Show on KMED, AM and FM this weekend. Pete Belcaster and Joe Brett, the real estate guys, with you. Thanks for joining us in our final show of this fiscal year, I suppose it is. We start year number 6 for us next week here on KMED. Joe, that's 6 years. That's a long time, isn't that? 5 years, 6 years?
Learned a lot on the show in those years.
We've learned so much and have had great guests, and I know that our listeners here on KMED appreciate that because we hear from you about that and different topics. You want to talk to many of the guests. Of course, you can go onto our website at realestateshoworegon.com, and that's where you can find any of the cell numbers or email addresses for any of the for guests of our show. You can contact them as many do. Well, anyway, it's exciting about that.
And also, archives of our programs are on there. So if you don't get all that Glenn's got for you the first time around here live on the show, go back to the archive at realestateshoworegon.com and you can pick it up there for good information.
Indeed. Well, anyway, welcome to Glenn. Glenn's a certified public accountant and business advisor. I met Glenn through the Ashland Rotary Club when he came to town and has been a member there since that time, and then became the owner, one of the co-owners of Nagel and Padilla 5 years ago, right? That's amazing, 5 years.
Time has passed really quickly, Pete,
Yeah.
but it's great to be here back on the show again.
Yeah, it's nice to have you here. And, of course, Glenn has got a great background. Joe, he worked for Macy's at one time. He worked for Amazon.com. He starts spinning some stories and make your head spin about some of his business backgrounds and things. And he shucked all that away to become a CPA. That's what you call dedication, that to do that. Anyway, nice to have you with us. What's been going on for this last year? In the year that you were here last year at this same week, what's been the biggest change that you see in terms of investing, all the kinds of real estate things that we talk about in the last year?
Things seem to definitely be on the upswing, Pete. The real estate market seems to be improving, and many of my clients who have owned property for long periods of time, or even 3 or 4 years, are looking at opportunities to create additional wealth by moving from one property to another property. Mm-hmm. So the market is improving, and instead of people being primarily worried about how they're going to make their next dollar, they're becoming more concerned with saving on tax. And that's usually a positive consequence of good business. And so it's been really exciting. It's a lot more enjoyable talking to people when things are on an upswing and they're feeling optimistic than the opposite.
Because when you took over, you became there at Nagel and Padilla 5 years ago when we started the real estate show in the summer of 2009. It was not good in any stretch of the imagination. So you must have felt that in your business, obviously, because we've certainly seen it here. You talk about a change in market. 5 years ago, Joe, the majority of the sales were foreclosed properties and short sales, and that is
prices were depressed.
Prices were
at the
bad.
valley. Yeah.
Values had gone down. It was not. It was a bad time. But so look how it's changed, Glenn.
It has changed a lot, and the good news for our business is that when there is good business, there's taxes to be paid, and people have some available wealth to be able to plan more effectively. Yeah. Instead of reacting to things that have happened, they're in a better position, and it's great that we can work with them to help plan so that they can pay less tax in the future. Mm-hmm. It's a lot more exciting to be doing it from that perspective, and now people have good problems, and it's really encouraging to be helping people plan for their good problems.
Well, we always ask Glenn what are some of the things you want to talk about today, and you've got some great topics, things that we've talked about in the show. Our listeners have certainly heard us talk about these things, so to get your perspective of what's going on with it is really cool. So talk first about buying versus renting now, today in 2015. Because certainly it wasn't that long ago when we're all talking about renting bad. Wealth building generation, you have to buy property, those kinds of things, right?
We had a period where you could buy a home for the same amount of money each month you were paying your rent.
Right. So it made sense, certainly in 2009 when we, years ago, to do that. So what's the status today of it?
Well, the circumstances are continuing to evolve. back before I was practicing in accounting here, property values, particularly in Ashland, but certainly throughout the valley, were growing at very, very substantial rates. There were increases in single years in the double digits.
Oh, yeah. Well, we're back to those again, just so everybody knows that. Okay.
And that had a very different effect on the rent versus buy decision, because people could be in a property for 2 or 3 years and flip it and be able to offset very easily the fixed costs of selling a property.
Okay.
You know, there's substantial costs in selling a property between what you're paying the title company, the costs of paying the real estate brokers, all of the transaction fees that are involved, the loan fees that are involved. They can be, you know, easily $10,000 on a transaction.
Absolutely, yes.
And in the environment where property values were growing in low single digits or not growing at all, it was really, really hard to substantiate that. And in many ways, the closing costs are a really critical component about whether or not to buy versus rent. Things are moving back in a more positive direction, and so there are greater advantages. There may be greater advantages to buying now, but you really need to think about some non-economic factors when you're making that decision. And one of the most critical ones is, how important is permanence to you? How long do you plan to stay
To be in that house.
and in this community? People are much more mobile than they used to be. They want to be able to react to work opportunities. And frankly, the work opportunities in this valley can be very, very constricting. So people may have to move. And if you have to move in a quick period of time, you may not be able to offset costs of buying that home.
The average, I think the average person stays in their house when they buy it. You know what the average years is? It's around 7.2 years they before you turn over a house. Okay.
But being younger
Right.
can put great restrictions on your ability to do that.
Right.
Because if there's a great job opportunity in a community outside the valley, you're going to need to move. And you may not be able to say that the investment in that home, if you purchased it, you were able to offset it over the course of the time that you lived there and the increase in value that you were able to get.
For the money you put into it, the value hasn't gone far enough and up to
Absolutely.
offset that. And then the cost you're going to face to move and buy again.
Okay.
You're absolutely right. And one thing, sorry, Pete,
Okay.
to interrupt
No.
you, but one thing that people often don't think about is what it actually costs you beyond the closing costs to move into a house. How many times have you moved into a house and within a month the furnace goes or the dishwasher goes, because those were the non-visible things that people didn't really pay a lot of attention to when they were thinking about selling.
Right. Now, we've known, Joe and I have known media people over the years who've come in and out of Medford. And those who've come in, and I'm certain people who've come in and bought property, sold it, moved on to the next place, have come here and they've been doing that same thing. They always came out ahead, didn't they? Yeah. In selling, of buying and selling as they moved, even if it wasn't for a long period of time, because they got benefits from its tax benefits, its, I guess, write-off benefits as well, isn't it? So there is something to be said for that in terms of buying and selling as you move through, move up, right?
And there's a business where you can move a lot. Unexpectedly at times.
Yeah.
The bottom line is, if you can get a house with a monthly payment that's close to what it would cost you to rent, there's much greater tax advantages to being a homeowner. But you have to put a lot more into the property because you have to put a down payment.
You're a homeowner.
You have a debt obligation.
Yeah.
Bad stuff happens. You're the one that's responsible for taking care of it. But on the upside for home ownership, you don't have to worry about renewing your lease every year. If you have a mortgage, your payment is fixed for the life of the loan,
or
generally.
the cost goes up. And what we've seen here in our own valley with vacancy rates below 1.5%, those costs have gone up for renters. So maybe that correlation of buying is probably pretty close again. So that's a good thing. We also want you to tell our listeners, Glenn, about 1031 exchanges. I heard at one time in some meeting I was at, I heard that they were going to go away, that they were going to lose them. That was not going to happen, but that did not occur. So tell people what a 1031 exchange is and why, in some circumstances, this may be a smart thing for them to do.
That's a great question, Pete. Thanks for asking it. But before we get into the 1031 exchange, we focused a lot on both the economic and the non-economic aspects of renting versus buying. At our website, which is www.nagelpadilla.com, we have a calculator where you can put in the cost of renting versus the cost of buying and take a really close look at the economics of the decision. Well, 1031 exchange, it sounds, by virtue of the fact that we use an Internal Revenue Code section to name what this is, it automatically makes it sound a lot more complicated than it really is. But what a 1031 exchange is all about, and the way I prefer thinking about them is it's a like-kind exchange. It's a way to defer, not eliminate, but defer tax on gain. Let's say you own a rental property. And before we came on the air, Joe was talking to me about the increases in property values here in Medford. Say you bought a property 10 years ago for $150,000. It's worth $250,000 now, potentially. You have a gain of $100,000. At between federal and Oregon capital gains rate, that $100,000 gain on sale could cost you $25,000 in tax.
Okay, now, before we go on from there, can I ask you a question on that?
Sure.
I thought that a couple or an individual, if you have a capital gains first time, I think it was $250,000 per person and $500,000 per couple. That what role does that play in this? That's
another really good question, Pete. You're referring to what's called the exclusion on the sale of a principal residence.
Okay.
When we start talking about a 1031 exchange or a like-kind exchange, we're actually talking about business or rental use property. Principal residence gain is excludable from income for an individual.
But just my primary residence, not my rental, not my investments or anything. It has to be my primary residence. Well, that's good to know because I quite didn't quite get that. Okay.
So principal residence gain is excludable from income. It is not taxed at all by the IRS or Oregon to the extent of $250,000 for one person or $500,000 for a married couple filing jointly. So there's a significant legislative incentive to be a homeowner from a tax standpoint in a time of appreciation. There are some limits. You have to be in your home for 2 of the last 5 years and use it as your primary residence in order to be able to qualify for the exclusion. And you can't do one of these more than once every 5 years.
Okay. Do you see people doing 1031 exchanges, most of them primary residence exchanges or investment property exchanges?
So you can't do a like-kind exchange on your primary residence.
I can't.
You cannot. You can only do a like-kind exchange for business or rental property. So you purchase a residential rental.
It's not your primary residence.
Or a commercial building, you can do a like-kind exchange.
And that's how that would come out. Okay.
And as I said previously, it is a deferred gain. So if you do, instead of selling that $250,000 property that you paid $150,000 for 10 years ago, you can make the decision to defer that gain and invest the proceeds in another like-kind property.
Okay.
You could buy another residential rental. You could buy a commercial rental. And essentially what you are able to do is you get to realize the gain because you have received that $100,000, but you get to defer it because you're investing it in another like-kind property. So you could purchase a property for $250,000. You're not eliminating the tax, you're deferring the tax because when you sell at some point in the future, you do have to recognize that gain that you previously deferred.
At some point you're going to get it. Is there a limit to the number of 1031 exchanges a person can do?
No,
not
that I am aware of. We have clients who engage in multiple like-kind exchanges in a year, and you can have one property that you're selling and buy 2 or 3 properties, or you could put the proceeds from multiple properties into a single
okay.
property.
Okay, I didn't
so
know
there
that.
are lots of creative opportunities. Like-kind exchanges can be very complex.
Yes.
And you need to really feel that deferring the gain is the best economic situation for you, because there are significant additional costs involved, because there's multiple parties that need to be involved. You not only have your buying real estate broker and your selling real estate broker, but you have the title company involved, and you have to use, and it's strongly recommended that you use an exchange facilitator who acts as the middleman between the purchase and the sale of the properties that are involved in the exchanges.
And we're seeing those. Is it safe to say that a 1031 exchange is a way to increase the value of your portfolio by being smart with it and doing it? Is that fair?
You can use it to do that, but the primary benefit is to keep the money in your pocket for a longer period of time.
All right, we're with Glenn Cunningham, CPA from Nagel and Padilla, here on the Real Estate Show this weekend on KMED. Lots of good information. Don't you dare go away. We're coming right back after this. The Real Estate Show rolls on KMED, AM and FM this weekend. Pete Belcaster and Joe Brett, the Real Estate Guys, with you. We're both brokers with John L. Scott, Southern Oregon here. I'm a principal broker. Joe's a broker with John L. Scott. And we get together with you every week here on KMED to talk about all sorts of real estate-related topics and issues. And man, we're almost approaching 300 shows, actually, if you can believe that. So that's a lot of hot air has flown through these microphones, but then a lot of hot air does flow through them.
That's the gold standard, for Major League pitcher. 300 wins.
300 wins.
Even 300 starts nowadays is almost unheard of.
Well, one of the things that's certainly changed is the market has changed is the investment world, in terms of what we've seen in investing properties and rentals and everything from we hear from Laurel Adams, at All Cities Property Management about that, and how clients come on, buy properties, those kinds of things. It's quite a story. Next week, by the way, Sheriff Corey Falls will be here for our 4th of July show, and we're talking with the sheriff really about legal marijuana and what can real estate expect from law enforcement as this new law comes into effect. It's going to have obviously a big significant impact, I think anyway, on our state.
I just think he just rounds out such a diverse lineup of guests that we're able to bring folks throughout the year on the program, such as the one we have in studio today.
Yeah, Glenn Cunningham is the co-owner and CPA business advisor from Nagel and Padilla down there in Ashland, and has been coming on our show for many years now. We talk about this kind of stuff. Tell me about one of the things that's really changed, and I know a lot of listeners will have an interest in, is the home office deduction. Because I remember, I think it was you first said to me, years ago, don't put any red flags up for the IRS. Home offices are going to get flagged, you're going to get audited, and don't do them. Well, it sounds like that's changed a little bit. Is that right, Glenn?
Well, I'm not quite sure I said to you never do a home office.
It might not have been you. It might have been somebody else.
Yeah. I've always been in the school that is, if you're entitled to a tax deduction, you shouldn't allow concerns about being audited to prevent you from taking deductions to which you are entitled.
That makes sense.
If you are engaging in an activity that's generating income, you are entitled to take tax deductions against that income. And you shouldn't be doing things because you will be audited or not doing them because you will be audited. You should do them because you're entitled to do them.
Okay.
But home offices are something. It's really interesting. We've talked a lot in the first part of the show about how the economy is changing here in the Valley and how things are definitely on the upswing. And 5 or 6 years ago, when I first moved back here and purchased the practice, people were engaging in businesses at home because they couldn't get work.
That's true.
And so
they had some great infrastructure by which to work from home.
You're right.
And they were balancing lots of different activities to put food on the table. Mm-hmm. Today, as the economy is improving, people are suddenly seeing opportunities to grow their wealth by engaging in new activities. So while having to work from home was something you needed to do. Now people are excited about working from home because they can engage in business activities that they think are going to help increase their wealth.
Well, we're seeing certainly a revolution all across the country. Real estate offices, for example, don't need to be as big as they used to be. Remember, banks used to have all these bankers in there. I think you're getting a loan with the bank. You don't even have nobody.
I finally talked to a human. It's about 23 days in.
So the point is that people can work from home more and more, and they do. Well, we sell a lot of real estate, actually, of clients, and that's one of the things many look for is, is there a place for a home office? Is there a place for a shop? Is there a place that I can do economic activity within my residential area? Is that something that's It seems that that's a real popular thing, and that's something that more and more people would like to do.
And it's not only that people want to do it, as you referenced, in some cases their employers require that they do it.
Oh, okay. All right.
Because employers are trying to also cut back and reduce their investment. And if they don't need to put a cubicle or a desk in for somebody, then they can have them work from home and have them cover some of the costs and burdens of providing that office space.
That makes sense.
But one consistent in all of this is that if you do work from your home, you need to have a space that's regularly and exclusively used for business. And those are two really important criteria, both of which need to be met. You know, I ask people sometimes, do you work from home? And they say yes. And I say, where's your home office? And they say, well, I could put my laptop on the deck or at the kitchen counter.
Like I can take my office with me,
And unfortunately, that doesn't qualify as a home office.
You have to have space, right?
You have to have space that you regularly and exclusively use.
Okay.
And I strongly advise clients that if they whether they have a separate room or not. And you don't really need to have four walls around the space.
Right.
It could be a portion of a room, but it needs to be exclusively dedicated to business.
I see. I've got a third bedroom that is dedicated to office space,
to business,
gear storage for all of our sports endeavors.
And I have
and all
my
of that.
office too. I've had that for a long time. What about?
And if you ask my wife, I spend way too much time in there in that office.
What about shop spaces or spaces outside the house?
So if you have an auxiliary building on your property that you are using for business, like a shop or a workshop or storage space,
fifth wheel.
Well, not unless you're using the fifth wheel for business, not necessarily. But all of that qualifies as home office space and can be deductible as long as it meets the criteria that we've previously discussed, which is regularly and exclusively.
Okay, now where does it fit in? Because I've seen many properties when I show clients additional dwelling units. I mean, there may be an apartment over the garage that they rent. There may be, a little cottage in the back of the yard, that people have that they're renting. What should they do with that? Because there's a lot of it, and a lot of new construction, comes around with that, was putting an additional unit above the garage. So you had some income, you had a mother-in-law cottage, you had a place for, that kind of thing.
If you're using the space to generate income and you're paying tax on that income, there is invariably an opportunity to deduct some of the costs that are involved in maintaining that property. So if you have an auxiliary building or an additional dwelling unit in your house and you're either using it for business or renting it out, there are ways to deduct those expenses. And in the most cases, it's pretty simple. It's based on the square footage of this particular space that you're using as a percentage of the total square footage of the unit. And then you get to allocate portions of expenses based on that ratio. So say you have a 2,000 square foot house and your home office is 100 square feet, or your additional dwelling unit is 100 square feet. You can then allocate 5% of your mortgage interest, 5% of your property taxes, 5% of your utilities to that property, and then deduct those. You also get to deduct, and this is a little bit more complicated, what's called depreciation. You can depreciate 5% of the house.
Is it worth it for most people to do this?
Well, it's becoming increasingly worth it.
Okay.
And the reason is 2 years ago, the tax authorities made it easier to take a home office deduction.
It's kind of keeping
okay.
with the times, and the real estate industry is an excellent example of that. As technology has changed
Oh,
how
yeah.
we do business,
I do
agents
my
can be
business at home.
licensed. Yeah,
I mean, I do. Yeah. I mean, I
you don't even have to.
I don't need to go down
have
and
a
sit in an
desk
office
space or an
somewhere
office space per se.
So there are two ways. You can use the regular method, which is the actual expense, or they have a new system that came into effect 2 years ago called the Safe Harbor Office and Home. If you take my example of 100 square feet, you get to deduct $5 a square foot for your office and home.
Mm-hmm.
So that's $500 a year. And for many people, are at the 25% federal tax bracket, 9 or 10% Oregon tax. If they're self-employed, they're paying employment taxes. You could be paying somewhere in the vicinity of 42 to 45% tax. So $500.
It's really depressing.
It is really depressing. So $500 lower income is a couple $100 less tax in aggregate.
Well, see, these are the
is
things that
why you
Glenn,
need
we hear from
professional
Glenn,
help.
and we
Yeah.
want Glenn to tell us because he's smarter than us. So when you do this, you don't want to be. We want you to be a smart real estate consumer. That's the
Exactly.
whole purchase of our shows, and that's exactly what Glenn says to do there. It makes a lot of sense, and people should take advantage of that. I am this year for the first time in years going to do that. So anyway, the Real Estate Show with Glenn Cunningham from Nagel and Padilla CPA. We're coming right back in a minute. Real Estate Show rolls on KMED this weekend, the last weekend of June of 2015. Boy, weather certainly, the weather people got it right this week, Joe, didn't they? They said it was going to be in the triple digits, and they're right on that.
You know that I,
jeez.
You know that I embrace the heat, so I'm ready for it.
Well, I hope you enjoy it.
Bring it on.
Hopefully we'll get some thunderstorms, maybe lots of rain with it. That'd like that. Hey, next week here on the Real Estate Show, Sheriff Corey Falls. He was elected last November, Sheriff of Jackson County. He's going to be with us next week on our 4th of July show, talk about real estate and the new legalization of marijuana and what we can expect from law enforcement in terms of some of the, I guess, rules that are coming down. And it seems like, I know the Medford City Council changed. I mean, everything is in flux. Everything's changing. Nothing's really set in stone as this experiment, I guess, begins next week, next Wednesday.
It's such new territory for everyone. It'd be great to have Corey in to kind of give us law enforcement side of things, and also just to check in on how his transition. And he's made some big changes and is completely restructuring the sheriff's office. It'd be nice to.
He's good at that.
We'll get a update on that.
Restructure the sheriff's office.
Pete, you just go right for the gold.
Glenn, would you want to hear that out of the sheriff next week?
Pete goes right past the copper and silver. He's going to mine the gold.
Let's go restructure the sheriff's office. Anyway,
I have a feeling Corey will be a lot more politically correct than you guys
you
are.
think? Yeah.
We'll be on our best behavior next week.
And Corey, also a member of the Rotary Club of Ashland, like Glenn, our guest today, is, and myself. Anyway, Glenn Cunningham is a CPA from Nagel and Padilla, CPA and a business advisor. So Glenn, it's great to have you here. We've talked a lot about different things today, and you cannot get out of our last segment without talking about legal marijuana and taxes and what is going on in your world. Tell us what you think about all this. I'm curious I've never asked you about this.
It's an incredibly complex issue. And the government...
It's kind of like a 1031 exchange sometimes,
Well, it's incredibly complex, and the various jurisdictions are doing very little to help reconcile the complexity.
Mm-hmm. Including the Oregon legislature, I might say.
Well, the federal government, the state government definitely don't seem to be working together, and there are lots and lots of issues to getting into the legal marijuana.
And that's important because it's the federal people who do the tax thing.
Absolutely, or the medical marijuana business. And we've had medical marijuana here in Oregon for
some time,
a number of years now. And we still don't have a solid set of rules around which people can operate and which create a business environment, an environment that is healthy for business. So if you're in the medical marijuana business or you're in the recreational marijuana business, you can't open a bank account.
Cannot.
You cannot open
even in a state bank or a local bank.
Well, that hasn't been resolved yet.
Okay, see, these are just the things we talk about. I know.
Colorado and Washington are in the process of trying to get banking set up, but banking is controlled federally.
Okay, if you have clients like that who are in these businesses, How do you deal with them? What do you, as the CPA?
He tells them it's a very
What do you tell them? It's a
complex
very complex. What do you do with all this cash? What do you do with this stuff?
Well, I think the classic example is I think it's the Oregon Liquor Control Board
Yeah.
that is going to be managing taxation of recreational marijuana. I've just read an article, I think it was in the Oregonian, that they had to invest hundreds of thousands of dollars in a new secure cash handling facility.
Wow.
Because there are no ways for these people to be able to get a bank account so they can write a check.
Wow.
5 years ago, the IRS stopped accepting payroll tax payments in cash or at a bank. You have to wire money to the IRS to pay payroll taxes.
Okay.
There's no way for anybody in the recreational or medical marijuana business to pay their payroll taxes unless they can figure out a way to get cash to the federal government.
Cash is good everywhere except with the IRS, Joe. Remember that, okay? Cash is not king.
What do they know that we don't know?
Cash is not king with the IRS.
And we spent a lot of time talking about what are deductible expenses. We talked about deductible expenses for a home office. Well, classifying deductible expenses in the medical marijuana business and the recreational marijuana business is incredibly complex. Because of long-standing federal rules, many of the costs involved in being in the medical and recreational marijuana business are not deductible for federal tax purposes. So say you have $100,000 in sales and $50,000 in expenses to conduct that business, of which $10,000 is the cost of the marijuana that you're selling. You can only deduct the $10,000.
Okay.
So $100,000 in sales, $50,000 in expenses, that would translate to income of $50,000, right? But you're paying tax on income of $90,000.
Wow.
But are they paying tax on that you hope they are, correct?
Well, whether the business is legal or not for federal purposes, you're supposed to pay tax on it.
Okay. Yeah. Okay.
So the bottom line is, saying that medical marijuana and recreational marijuana is complex in the same breath that I said a like-kind exchange is complex is comparing apples and oranges.
What do you recommend to people who are, I assume that there are people getting ready, I mean, I don't know what's going to happen next week. I assume there are more people getting ready to grow, to do all sorts of things. So what do you recommend to people here, Glenn?
I'm betwixt and between on this. I often recommend things to people based on what I would be comfortable with. And I really value working with people who are business-minded and are looking to make money. But I can't in good conscience recommend to people that they enter the medical or recreational marijuana business until
it's
these
resolved.
discrepancies between the federal government and the state government are more clearly resolved. Because the burdens of running the business are so much more complex. And I've read stories, particularly in Northern California, where law enforcement worked hand in glove with the providers of what is now medical marijuana. And the federal government swooped in because they didn't like the way things were being managed and actually threw out everything that the local law enforcement did.
Well, as we have to go here because as anyway,
They came with
as
a
we
big
go to
backhoes
July
in Jackson County and just ripped it out of the ground.
Well, as we go to July 1st, it's certainly unresolved, and so we got to talk about this. We're not out of the time. How can someone get a hold of you, Glenn, if they want to talk to you or anything like that?
Well, we've got a website, www.nagelpadilla.com or 541-488-1551. We have an electronic newsletter. You can subscribe to it at our website.
All right.
Great show, Glenn. Thank you.
Always nice to visit with you.
very much.
That'll do it for the Real Estate Show this weekend. Have a great 4th of July. Stay cool, everybody, and God bless to you all. Have a great week from the Real Estate Show here on KMED.
Thank you for listening to the original Real Estate Show with Pete Belcastro and Joe Brett, the Real Estate Guys. For advice, guidance, or counsel on any of our topics, or to watch a replay of today's show, visit our website at realestateshoworegon.com. This show is sponsored by RE/MAX, Ideal Brokers of Southern Oregon, Ticor Title, All Cities Property Management, and the Jackson Soil and Water Conservation District. We'll continue our weekly quest to enhance the value of your property and to make you a smart real estate consumer when we gather every Saturday and Sunday on KMED for the one and only original real estate show.